obviously went through it, and it's different type of, VC, but if you want to break it down and just explain to people what is the difference between this new way of funding that you guys are putting together, and obviously, having the backing of FirstMark is awesome, and having the team that you were working with there shows a lot of the credibility for it, and I think it's something that a lot of founders should look into doing if it's the right fit for them and if it makes sense. And like you said, they want to retain their equity and all this stuff. So I think it'd be great if you could break it down a little bit, just so you can help, so people can kind of understand, what you guys are doing with your new fund.
Yeah, sure thing. So as Michael alluded to, we are investing a little bit differently than your classic VC. So as a little bit of background, one of the things that I think we really came to understand well in our previous lives as VCs is the instrument of investing itself. So for the past 50 years or so in the VC industry, the main product, if you call it that investors are selling is a preferred equity financing or derivatives thereof. So a convertible note is essentially something that becomes a preferred equity type of stock. A safe is literally that, right? An agreement for future equity. And so one of the things that we came to understand well is what it means to take preferred stock in your business. And the simplest way to describe it is if I'm an investor and I invest basically preferred stock in your business, the way that I make my money as an investor is that eventually someday somebody buys that stock off of me for a major appreciation. There's other ways to make money on stock, like if it's a dividend stock and if you can use leverage around that, like some of the later stage private equity firms. But generally speaking, for VCs, their business model works on buying stock in a business and then selling that stock at a later point once there's a bunch of value appreciation. So what this presupposes for the VC business model to work is that companies have an exit, and usually a pretty large exit too, within a certain amount of time. So with preferred stock, whenever you raise preferred stock, there's usually a conversation, explicit or implicit, with a VC that's like, hey, how do we position this company for really big, really valuable exit someday? And usually, the building blocks of that are executing really well, making your customers super happy, having best-in-class products, very tight, network effects, all those types of things. But all of those put together, plus growth and some luck along the way, hopefully results in like an IPO, hopefully results in a big strategic acquisition that can return an investor 10 times their initial investment to sort of compensate for the risk of getting in very, very early. So one thing that is sort of missing from the equation of VC is what happens if a company decides at some point that I don't know if that's for me. I don't know if I necessarily want to build toward like a really big outcome in a defined timeline. Maybe an entrepreneur thinks I want to build like a really big, really profitable company. And if somebody comes along and says, hey, I'll buy you for a huge amount of money, then like, of course you'd say yes to that. But if that doesn't happen, if you're comfortable running like a really big, really valuable company that has a lot of profits attached to it, you can make the case that VC is probably not the right path for you, especially because people are looking for particular outcomes along, in a particular time frame. So when you take on preferred stock, that's one thing that you always want to keep in mind. The other thing that you want to keep in mind is that it also goes to how the VC business model works. So as a VC myself, I also fundraise and similar to all the companies that I work with too. And in order to fundraise, at the core, the case you want to make is that you are a better risk-adjusted return on capital than investing in the stock market, keeping your cash in the bank account or under your mattress. And so for VCs, the thing that's in the back of their head is obviously the returns can be really, really big if you hit like a Facebook, et cetera, and that should be attractive for outside investors. But that also needs to be weighed against the fact that honestly, a lot of startups don't really, have huge cash outcomes. And so, obviously there's high failure rates, plus the fact that there's a bunch of illiquidity in this world means that if you deploy $1 into a venture fund, maybe after 10 years, it's marked at 5 times or something on paper, but you may have only seen $2 or so in returns. And so that dynamic of illiquid early stage private investing usually drives VCs to look for things that can create a bunch of value really quickly and go for really big outcomes, because that compensates for the fact that you can be very illiquid for a very long period of time. So what that means for companies is actually really important, and I'll take a little bit of time to explain this. So what that means for companies is that you need to be growing pretty quickly to get a VC excited, and also to keep your VC sort of aligned with you on what the outcome for a business is. And so you might have heard some things out there, especially in enterprise software, where you want to like triple your revenue in the early years and then double it every year after that. For consumer business, it's benchmarks that say, depending on your market, you should be like, 10 times within 2 years, assuming you have like the marketing spend, the unit economics to do it. And so this is a very particular way of growing a business. And as part of that, the VCs typically need you to be fundraising a lot, so you continue to have liquidity, you continue to have capital go for a big outcome, and also so that the VCs can continually show this appreciation of their stock on paper, so that's their report card essentially back to their own investors of like, see, look, like the portfolio is working, you're not seeing a lot of liquidity yet, but the paper value is growing very quickly. So if you're a company that thinks to yourself, like, I don't know if that's necessarily for me, and I'd like to build a business that might take only a little bit of capital in the early days and then run profitably as long as it needs to run. There's an argument that isn't always the best fit for most VCs out there. And we just started seeing so many of these companies that we at Reformation wanted to sort of examine the preferred equity dynamic of venture and see if we could do something a little bit different. So we are investing, as Michael alluded to, on a slightly different instrument. And instead of going into like all the details of it, I'll try to summarize it in super basic terms as like hybrid equity and debt. So, and it behaves differently based on how a company grows after they work with us. So we have a $20 million fund. We're trying to invest about $500,000 to $1 million at a time. And the companies that I think make a bunch of sense for us are generating revenue. So I don't think for our model we can do pre-revenue businesses. We're still sort of toying with what the right revenue thresholds and other metrics are, because honestly, we're a pretty new firm. I've only been doing this since January. But the goal is to back companies and say to them, hey, if you want to, like, here's your working capital, you can build a business with this, and you get a partner who's done this, many times before, and who can be really actively helpful in the business. And so we'll say to them, look, if you want to go the traditional venture path, just make sure you know what you're getting yourself into. It's usually a lot of time spent fundraising, a lot of time spent on investor relations. Raising at a certain valuation typically means that you won't be exiting at a valuation around that point. And so much has been written about sort of the trade-offs with VC, and one of the opportunity costs is that if you raise $100 million valuation and someone comes along and says like, hey, I'll buy your company off you for $50 million and you own 60% of the equity, that's it's life-changing amount of money. And oftentimes your VCs will discourage you from taking that, or they will have actual preferred equity blocks in there so that's not a possibility. And that's understandable given that the VCs are underwriting you to a really big return. So what we tell companies with our instrument is, if you want to go for a really big VC, outcome, that's fine with us. But if you don't want to get on that like treadmill or hamster wheel just yet, work with us and continue to bootstrap. Maybe raise some smart debt capital here and there. And then if you do that, our instrument will function more like debt, so that we are able to get a return on your business without requiring you to fundraise or sell.